All right. For this week's topic, train discussion, we're going to go over what to look for in stocks or ETFs in order to build your portfolio. Now, before we discuss our strategies, let's first go over what an ETF is and how it's different from a stock. ETF stands for Exchange Traded Fund, which is traded on the stock exchange just like stocks. The difference between the ETF and a stock, which only focuses on one company, is that an ETF tracks an index, a commodity, bonds, or a basket of securities. So basically, picture that you have a bunch of different companies or stocks in a basket, right? That basket is what an ETF is. The benefit of owning an ETF are that one, it allows investors to get involved with either an entire index or industry with a single investment, and two, it can help hedge risk associated with individual companies. So now that I gave a brief summary on the difference between a stock and an ETF, let's jump right into what the Eternal Money podcast team looks for in stocks or ETFs when building a portfolio. So actually, let me just start it off. So during the summer of 2020, at the prime of the pandemic, it was actually Nick that educated me on how to invest, and he gave me guidance on how to invest my $25,000 that I wanted to use to start towards building my own portfolio. So simply put, this is exactly what Nick told me to do, right? So please make sure you're taking notes and remember this. First thing he told me was on Fidelity, which is what I used to buy, or the platform I used to buy or sell, was to invest 60% of my budgeted money into SPY. Then for the 40% that I had left, he told me to invest in blue chip dividend stocks. So naturally, I said, damn, homie, there's so many to choose from. He said, Flip, that's what you got to do, man. Look around your house for products that you use on a daily basis, right? When you do that, think about, and after that, think about the companies or products that you usually buy from that you like. So now that you've done that, make a list of those companies and find out what market sector they're in so that you'll have a sense on how diversified your portfolio could be, right? So after I did that, I continued diversifying my portfolio by just making other purchases from different market sectors that I haven't had stocks in, and I was looking for long-term investments with good PTE, price to earnings ratios. So with that being said, and that was a lot, just to recap, my first tip would be to look for companies with good price to earning ratios and just following the steps that I mentioned earlier if you are new to investing. Shout out to the unit.
That's
Thank
beautiful. Good job, Flip. Well done, man. Well done. Yo, I appreciate it, bro. Appreciate that. All right, so let me get into this. I'll take it first now. All right. So there's a few things that I want to say. Number one, I want to make sure that this is clear. Now, this topic train this week, first of all, Flip was super hyped about this. I've been hearing about this.
Changed my life,
Flip
man.
Has been super
Thank
hyped
you.
to tell you guys about this. Yeah, man. Yo, you feel me, Flip? All right, so just so you guys know, we're talking about buy and hold investments here. We're talking about long-term investments. We're not talking about trading, okay? So let's just make sure that there is a distinction there. We definitely got to do a topic train about the difference, bro. This keeps coming up. We definitely got to hit that at some point. But yeah, so this is talking about long-term buy and hold strategies, okay? So we're talking about years and years of investing here, not talking about short-term in and out, in and out, in and out. All right, so the first thing that I think that you got to try to internalize and try to identify with yourself is you want to identify how much involvement do you want to have in this process, right? Do you want to be a person that is heavily involved in this, like we are, we're checking this every day and this is part of our everyday, or do you want to take the hands-off approach and just kind of let the investing do it on its own, right? So what I would say is, if this is me and that's my approach, let's say you're very busy, you have kids, and you just cannot manage it. My approach would be to invest in broad market, low cost ETFs, and what I would do is I would pick 4. And this is very similar to what I did in my Roth IRA when I first started in 2018. The first thing I would do is I would buy the S&P 500 fund. Anything that is there as far as S&P, that is okay. Because there's, brokers have different funds that they host and everything. So whatever your broker hosts as far as S&P 500, I would get involved in that. I would get involved in the QQQ. That's the top 100 traded companies in the NASDAQ, the technology sector. I would get involved in that or something equivalent to whatever your broker is. I would also get involved in a total stock market fund that just is broad to the entire stock market. And then the last thing I would do is I would get involved in an international fund. just so you have your hands in everything and you are diverse. Diversification as far as long-term buy and hold is extremely important. You want to be diverse. You want to have your hands in different things. So that's what I would do. I would recommend for anybody or myself, I would recommend those 4 to start with as far as broad indexes and low cost too. You don't have anything that the expense ratio is very, very high. Low cost things that you can just put it in there and set it and forget it. Now, as far as individual stocks, if you want to start an individual stock portfolio, that's great too. It just requires a little bit more management on the daily, right? So I have a mixture of both. I have index funds, and I also have a large portfolio as far as how many stocks of dividend stocks. So what I would say is this is what I look for when I'm trying to buy a dividend stock. The first thing that I look at is the dividend history. How long has this company had a well-established dividend that they're paying out to their shareholders? So that's the first thing that I look at. The second thing that I look at is the growth of that dividend. What is the growth per year on that dividend? Are you growing by 2%? Are you growing by 3%? Are you growing by 10%? What is the average growth of that dividend? And typically what I like to see is 6 to 8% growth per year. I feel comfortable with that, and I like to see companies that are thriving with that number. So, that's my baseline as far as that. Now, the next thing I look at is the payout ratio. The payout ratio is the percentage of the earnings the company is paying out to the shareholders. Now, this is extremely important for a few things. Number one, because if the payout ratio is too high, there's no room for that dividend to grow. And the dividend is just going to stay in that zone, and if it's too high, it runs the risk of getting cut. So you want to be in a sweet spot, and you have to decide what you want that to be. Typically, my sweet spot is between 50 and 60%. That's what I look for in my dividend companies. If your dividends is at 50 to 60% payout ratio, that means that there's room for that dividend to grow within years, and also it's stable, that they're making money, their revenue is there, they have free cash flow, and they're able to give out to the shareholders. So the payout ratio is extremely important. And then the last thing I think of, or I look at, is the yield. The yield, if you notice, that's the last thing that I look at because that is the least important of all this. The yield is how much money that they're giving you on your money invested. So typically what I like to look for is that 4 to 5 or 4 to 6% range. Maybe not 6%, but 4 to 5% range. I don't really go for the 1 to 3. I think 1 to 3, it's okay. It's very safe, but for me, I like to see a yield anywhere between 4 and 5, and maybe 3. Let's say 3 to 5%. 3 to 5% payers are good in my eyes. So, that's what I look for as far as individual stocks. So that would be what I would do. I would buy the index funds with those 4, and then as far as individual stocks, those are the criteria that I would look at for anyone to get involved in.
I think what you were trying to say when you started was, do you want to be a passive investor or an active investor like we are? That's what you were going for. Yeah. So,
exactly.
Yeah, I mean,
exactly.
I'm very similar to that, to what you just mentioned. But when I first started, I was really trying to just do a lot of dividend. A lot of dividend stocks. So I was trying to make it kind of like that the companies I bought, I would get paid almost every week, a dividend, So I was looking at companies, you know what I'm saying? I know it is, but that's what I was trying to do. But that took a lot of work, man. And I was like, I got to do a lot of research, this and that. So then a few years ago, I read this book. I read a book, and it's called the 12% Solution. So I read it. I looked at the stats that the guy, I forget the author's name, and it made sense. I looked into it, and all the stats were right. What he wrote in the book, right? So the strategy of the 12% Solution, which is what I do now, it's basically, so you're gonna pick you're gonna look at four ETFs. You're gonna look at SPY, QQQ, MDY, which is the mid cap 400, and the IWM, the Russell 2000, right? Those are that's where most of your money is gonna go, right? And then you're gonna have TLT, that's your hedge. TLT, which is the 20-year bond, and then JNK, which is another bond, it's a junk bond, like a high yield bond, right? So what you do, it's simple. The strategy is simple. You look back 3 months. You look back 3 months, right? At you compare all 4 ETFs, SPY, QQQ, IWM, and MDY, and whichever one is trending higher, you buy that one every month. Every month, you look back 3 months. So whichever one's higher, you buy it. You sell whatever you have, and you buy that ETF. 60% of your money goes to that ETF, right? So then, but only if the it's over 1% the last 3 months, right? So if it's not over 1%, like it hasn't been this year since we had all this downside, then you still buy your 40% of the bond. Whichever one, the same thing for the bond. Whichever one is higher, you buy that one the first of the month or the last day of the month, whichever, it's going to be the same either way, So then, and then if none of them are over 1% or over 0%, I should say, if none of them are over 0%, then you either the 60% of your money stays in cash and you wait for a month. And while that bond's still there, doing whatever it does, or you can put it in SHY, SHY. That's the 1 to 3. I don't know if it's 1 to 3 month bond ETF or 1 to 3 year. I think it's 1 to 3 month, and that pays you monthly. It's like cash. That's basically like having cash, So you do that. So this year, my money's been on the side mostly for my long-term investing a long time because since February, everything's been down. But finally, this month, after this rally, after the past 3 months, I'm back in. So 60% of my money's in IWM right now because that's the one that's been highest the past 3 months, over 0%, IWM, and then 40% is in TLT. So that's what I do now. And so year to date, that strategy is down 10%, right? SPY, even after this rally, SPY is down over 13% still this year. So it's not down 10% is not good, obviously, but it's better than the market, right? And then since 2008, the 12% solution strategy, it has almost doubled the performance of the S&P 500. I know it's hard to believe, but it's true. So that's what I do now because I like researching companies, but I just want to keep it simple and focus on trading. I love trading, so I like to look at, how am I gonna make more money to buy stuff, So yeah, so that's what I do for my main portfolio. And then, but I still look cool, even really with cool. That I still look to add stocks and stuff to it because that you got to build a core with the ETF, and then you could also try to juice that return more by buying stocks, right? So I stick to the large cap companies in the major sectors, and the dividend kings and the dividend aristocrats. So that's what I look at, and then I also prefer stocks to have more cash than debt. But that's not the final decider because I know that's hard and it depends what sector you're in. So, but stocks like that I like, and I always look for consistent profit in their business and revenue growth. That's what I look for in their financials. And like you mentioned before, if it's a dividend stock, I look for continued dividend growth and the payout ratio. Less than 60% is preferred for me, man. You said 50 to 60. For me, less than 60. So we're right there because we don't want that dividend to get cut. We don't want that dividend to get cut. So, and for me personally, I stay away. I won't touch them. I'll stay away from IPOs. I only stick to companies with a proven track record, man. So, yeah. So, I did buy
IPOs are for suckers, man.
I bought 4 shares of Robinhood when it IPO'd. Yeah, so and it went up. I think I bought it in the 30s, and it went up to 60s, and I was like, oh, I'm holding this, man. This is going to the moon. And then I think I sold them at $12. So I took a $80 loss total there. But yeah, so I like to keep it basic with my portfolio, but I think it works, man. So that's what I like to do, man. Yep. Hopefully people got value out of that.
Yeah. Yeah. I think I'm going to add one more thing real quick because it just came to me as we were talking. So a lot of people always ask me, how do I find stocks? You know, how do I find these dividend payers? And how do I come up with these ideas? And it's, you know, like I told Flip when he asked me, you know, the baseline of it is just look around your house and look at what household items you use on the regular. You know, that can give you a base. So what I would always, say, and what I would do is, if I were to start a portfolio, I would start with 10 stocks. That's what I would do in all different sectors. And then, like I said, I would go around my house and I would say, oh, man, that product's from Procter & Gamble. Oh, man, that shampoo's from Johnson & Johnson. Oh, my cell phone, this is from Apple. You know, so my computer is Microsoft. So, you know, these are the things that we're talking about. You could just go around your house and you can look at these things. You know, open up your pantry. Campbell's Soup is there. They're a payer. I have them in my portfolio. They pay me every 3 months. So, you know, that's how you want to formulate a portfolio. And the deeper you go into it, you know, going down the rabbit hole, things just come to you. So if you're involved in dividends come to you, and you find partnering stocks, and you find things that'll go together. And the more you learn, the more you discover different companies and, you know, what to look for. And like Nell said, you find companies that have good cash flow and good revenue and good earnings, and, you know, their debt is manageable. And these are the companies that you want to put your money into. So that's what I would say, how to you know, build a portfolio and locate the stocks. Because I think a lot of people get hung up on that, man. I think they're like so concerned about, how am I going to find these stocks? What do I do? Instead of like just taking a step back and just looking, like, what do you use on a regular? What car do you drive? You drive a Ford? They're a dividend payer. Go buy some of that. You know, like things like that. So if you put yourself in an abundant situation and you put yourself in that position to receive an opportunity, you're gonna find more companies. You're gonna learn about different things, and it's just part of the game. It's just part of life, right? You put yourself in there, you put yourself in a position to receive, and that's what's gonna happen. You're gonna grow. And then one day you're going to wake up and you're going to be like me with like 65 stocks in a dividend portfolio, and you're managing the cash every day.
If you don't want to start your own business,
that's it.
Investing in stocks is a good way to get into it, you know, because when you buy a stock, you're buying into that business, you know. So, I mean, that's all we got, man.